All right, welcome back. I think this will be a fun one for anyone who is unaware of this with Warren Buffett, or if you don't even know who Warren Buffett is, we can kind of dive into it. And if you don't know who I am Ben Collins. I'm a CFA charter holder, the founder and CIO of Options Autopilot. And here's the third video that I'm putting up on YouTube. Don't normally post, but we're trying to make a go of it. So if you appreciate it, subscribe. And we had a lot of good stuff down below from Options Autopilot in terms of education. So definitely check that out. But I wanted to go over, take these out. I want to go over Warren Buffett. And when you hear that name, what do you typically think of? His nickname's the Oracle of Omaha because he was supposedly, so good at stock picking and buying shares of companies. So he's just gotten this, I guess, reputation of just being a very good investor, which he is. And I just want to clarify if I say anything or it comes off negative, I think he is a great person. He's done a great job. I'm not trying to throw shade on him at all. I think people maybe need to understand some of his strategies, though, that he talks about less, or people who maybe just see headlines about him are unaware of, because he does actually utilize the derivatives markets. And in general, Berkshire Hathaway has a lot of insurance companies. So I think that there's a paper that was written more recently also called Buffett's Alpha, and that kind of looks at where he was deriving his success. And again, I think he's outperformed the market for a long period of time. I actually believe he's underperformed the market in the last decade. So that just kind of goes to show the changing environment we're in the actual financial markets. Obviously, his style of investing, value investing, probably became a lot more difficult as technology came up, and maybe got rid of some of those edges that he probably had in the past through very good due diligence. But in general, Warren Buffett was famously known to talk about derivatives as financial weapons of mass destruction. That is taken a little bit out of context, as we'll see later in the audio and video clip in general. But when you hear that, he famously was quoted for that. I think it was around 2008. And there were a lot of issues with derivatives in general, and that's what he's commenting about. But if you actually know the concept of insurance in general and just his actual strategies, he is actually a very heavy user of options. And he gets a lot of money through options and just through the business similar to options, which is, insurance. So if we go and listen to this clip, we will see that he is actually a seller of index put options, basically. And he also utilizes selling puts for individual acquisitions. If we look at this, I don't know what this is, but if we look at this, Warren Buffett again sells puts on Burlington Northern Santa Fe. So this is back in '08 as well. He was basically selling puts on Burlington Northern on a systematic basis. So that's where the automation can come in. You can do the same thing to copy him. But in this instance, he was basically selling shares with the potential of acquiring the business. So I think that this also raises an interesting question. I'm curious your guys' opinion in the comments. At what point is something like this considered insider trading, right? He's not necessarily someone that's part of that company at that point. But if you know that you're selling put options on a systematic basis and you're just going to eventually acquire the company anyways, then you basically know that you can make those put options expire worthless, right? I'm sure there's a restriction and I'm sure he followed it, but it's just an interesting thing that he was selling. Look at how much he was selling basically. And I don't know, does it show? I guess we'd have to look and see what was the stock trading at these dates. Maybe I'll go and look at that later. But he was selling all these put options on Burlington Northern. And I believe what it says is he basically pulled in, $1 billion worth of premium. So effectively he lowered his cost of acquisition by $1 billion by doing this. Now, if he would have been put the stock, then he would have been obviously buying it at lower and lower prices. But anyways, the point is that he was selling puts on a systematic basis to lower his cost basis, because I think eventually he knew he wanted to buy this company, right? So it didn't really matter. So he must have thought that the company was a good value at these strike prices, and he was willing to acquire it over time, as we can see by this right here. But most people, when they hear Buffett, they just hear, just a great investor, stock buyer. He also just recommends that the individual person should just buy the index, right? And so that's all well and good, and probably is the best route for the typical person. But in general, I think it's selling people short a little bit that they can't learn options trading themselves. So I wanted to kind of go over what he is actually doing and how you can easily replicate this with Options Autopilot, and how I have done it as well in terms of just selling index options. All right, so let's take a listen to Warren Buffett's options strategy a little bit, as described by, this is Russell Rhodes, a fellow CFA charter holder. Hopefully the audio keeps up. It was having some issues a little bit earlier.
He even mentioned that at times Berkshire Hathaway uses derivatives, but I think they're very careful about the way that they go about doing so.
And why are they so careful? What makes derivatives so risky?
Well, there's actually a professor that brings a class to CBOE every year, and I love what he has taught his students. If they hear the word leverage, they automatically think when it's really good, and when it's really bad, it's really bad. And leverage can be a benefit or a detriment of using derivative contracts. So, if used properly and used as risk management tools in the way that they were intended, they can actually lower risk instead of enhancing risk.
So that's annoying that the audio is a little bit off as soon as I start using OBS Studio. I guess it's time to upgrade a laptop. But this is where he kind of goes on to talk about what Berkshire Hathaway actually was doing. So let's see if we can just kind of go to that and listen to the audio more than the actual visual.
Actually done, and this is something that they did over a decade ago. So they actually sold over-the-counter index put options on the S&P 500, FTSE 100, Nikkei 225, and the Eurostoxx 50. And there's no counterparty risk because they actually received funds when they entered into the trades. And he notes that when he discusses these in each of his annual letters. Initially, they took in, over a time period from 2003 through 2008, about $4.9 billion in premiums.
So $4.9 billion in premiums is what Warren Buffett is taking in selling put options. So we can kind of look at that and try and model that type of success. So let's dive into what we can do there and see what we can do to copy Mr. Warren Buffett. And the one other thing I guess I will point out is Berkshire Hathaway itself, as an insurance company, pulls in premium, and then they are able to invest it. Obviously, they have to hold some aside for potential payouts of issues, but they can basically invest that wherever they like. So that is something to keep in mind, that the person mostly known for stock picking and or stock buying actually is a very heavy user of options in general. Let me just log into Schwab, because this is the example. If you go to Options Autopilot, we obviously have Tasty Trade and Schwab connected. We have Tradier and TradeStation as well. I did this specifically on Schwab. This was part of our initial testing, so I just wanted to do the put spread, and I basically did it on the S&P 500 index. But I'll pull that up right now and kind of show you what that looks like. But the takeaway is that Warren Buffett is a net seller of options premium. So if we wanted to learn a lesson from that, it probably would be helpful to model that because he's successful. But The key is, of course, to manage risk properly, right? So, alrighty. Pull up our, I mean, this is actual money, but it's a Schwab test account for us. So here's exactly what I sold. This is a live trade at the moment. And what I did is a put spread. And so we have a way to automate this strategy on Options Autopilot, and I'll go over that in a little bit here. We can see where the market's currently sitting. I am up about $93.94. Let's double check this. Yeah, $93 there. And basically, obviously, if you're unfamiliar with a put spread strategy, you're basically selling insurance. You're acting like a one-man insurance company is what they'll say. And you're pulling in premium and kind of accepting the risk if the market falls. And you can technically do what's called cash secured puts, and I'll go over these in other videos, so make sure to subscribe. I will post those later. Or we do have that in our course for free on Options Autopilot. You can request access. We've had quite a few people request access so far. So get in there if you want to learn all this. We go through all these types of strategies for free. And basically you are acting like they call it the TOMIC, the one-man insurance company strategy. And that's where you're kind of selling puts on a systematic basis and pulling in premium, right? And the key there is you obviously have to manage your risk. That's the key with any insurance company. Obviously, if you don't pull in enough premium and you have to pay out too many, claims, then you're going to go out of business, right? So we have to treat this as an insurance business where we cannot be paying out more than the premiums that we're pulling in. So in general, let's go look and see what we're at right now. So here's, right now the delta is actually 5. I think when I was selling it, it was 10 delta or 11. So the market has moved in my favor. Wasn't the case initially, but imagine we're selling this put. This is technically a 5 delta, meaning approximately a 5% chance of happening, like the stock or S&P 500 finishing in the money. But then we are covering our risk by buying a long put farther down, right? And again, these were at a higher premium, and the market was higher, actually lower at this point, so the deltas were higher. So this is kind of what's protecting our risk. So if we look at the actual risk profile, we can see that, okay, we can make $142. You probably never want to go for that full premium unless you're just selling it naked and letting it go. But as we can see, our max risk is $3,058, right? So this seems like a pretty stupid risk to reward, which on one hand it is if you're looking at the defined required capital that you're holding there. It's not a great percentage. Let's actually calculate what it is. Okay, so 4.6%. So actually not a terrible rate of return on that capital you're using, and that was over I believe it was so this right now we got 65 days to expiration. It was probably put on at 85 days, 89 days. Actually, let's just look at Options Autopilot. It'll tell us. So I'm almost at my profit target. My profit target is $98 and currently sitting, this is again not going to reflect the current market because the market's closed, but our debit of the current market price and the credit we originally pulled in is basically right here. So the system will monitor this position, and once it hits $98 of profit, it will just automatically close it. And if I have this set up to run either on a weekly or monthly basis, it'll just do that. But our stop loss is $210. So if we basically said, what's 98 divided by 210? So that's technically our risk. That's a 46% return on risk. And again, that is automatic. It will take it if it hits it. This position was down at one point. I want to say it was maybe down $15. So that's just one of the benefits of just letting things go from an automation standpoint. Let's see if I can zoom out here, but let's go back to the dashboard. And I'll just show you, if you wanted to replicate, I guess, what Warren Buffett's doing, maybe we want to call this, Buffett's Alpha or something like that. If you got ideas for names, let us know. But here is the short put spread strategy. All you got to do is click this button. We have other ones like the 112, 111. I'll go over those in other videos. You could also do naked puts. That's basically what he was doing when he was selling those index options. Obviously, he's not really naked because he has so much money he could easily buy things if he's assigned, right? So that would be more of cash secured puts is what it would be called. But let's imagine we're just going to do a risk defined and kind of more protected strategy, the systematic short put spread, where we're earning a credit. We're basically choosing our connection, brokerage connection, and then we're going to choose our ticker symbol. In this instance, I chose SPY. Oh yeah, it was a 90 DTE. So basically I was doing it on SPY. You can choose, you get a little bit better margin on the futures options, but that's only currently really available on Tasty Trade if you have a Tasty Trade account or if you want to sign up for one. Otherwise, you can do the ETFs or some of these other tickers. We have all the kind of popular futures options, and then the corresponding ETFs. But anyways, on this instance, we're doing SPY. So we're doing it on the index, S&P 500, and this is how we have our template set up, right? You can alter this. Obviously, it's your choice to be more or less aggressive. I can't comment on what's good for you. Set up your allocation here. It could be pretty little. Obviously, you have to have it be larger than the strike widths you choose for the deltas. You choose frequency, and then you just configure your stop loss, take profit, and your time stop, and then it just manages it for you. You don't even have to pay attention. I mean, you probably should pay some attention, but it will execute it just as you just directed it every single week if you chose that, and basically follow the rules that you set. And that's the issue, and that's the reason we created this. Is I can't pay attention to this stuff. I wasn't able to while I was working, but I wanted to be able to earn the returns on these that I knew was possible. So that's exactly why we built this. So if you basically want to replicate Buffett's option selling strategy, you can do it at Options Autopile. Maybe we'll do Buffett's Alpha or something like that. Again, comment below if you have a good idea for the name of it. But I just wanted to kind of touch on that briefly and go over, what exactly he is doing. He is using, and again, it was annoying that audio didn't necessarily pick up very well with the video. He was selling extremely long dated put options. It was 10 years long, I think. Some of them were 10 to 15 years. So that's not going to be possible. You could do leaps. That's possible as well. But in general, based on how theta is, and again, if you don't necessarily know what I'm talking about, go to our site, request access, and you can go over the course. It talks about all the Greeks and everything like that. The theta decay is actually better, 90 days and shorter. So that's usually why people will sell options on a shorter time frame. But there are some people who like to do, 100, 120 day kind of long-term put spreads, or even just naked puts is some of their benefits. So again, just wanted to go over that, give that example. And I always think it's interesting to think about, Warren Buffett. You don't think about him as an options trader, but he's actually probably one of the bigger options traders out there. So hopefully you found this helpful, and share it with someone who didn't know or maybe could benefit from the information. And we will see you in the next video. Appreciate it.